Welcome everyone. What we wanted to talk today about shifting gears from momentum and growth to value investing, and we really strongly believe that this calendar year 2018, that we'll look back on this year and we'll see it as a year where it made a lot of sense to rebalance portfolios or shift gears from growth and momentum to value. And today we have Stephen Bruce, who's one of our head guys here with me at Perennial Value and an investment director of portfolio management. And Steve will be adding some really interesting insights to this discussion as well. But Steve, do you want to give just a brief overview as to what we are going to talk about?
Thanks, John. Hi, everybody. So we're going to talk about some of the factors that have been influencing the market over the last number of years, particularly since the GFC. And then I'll talk about some of the impacts that's had on the market around valuation dispersion and what that means for investors going forward.
Yeah, thanks, Steve. So just a little bit of history, because I think it paints a picture as to where we are now. So post-GFC, going back almost a decade or so now, two major macro factors that have really driven growth and momentum investing, clearly quantitative easing and also unsustainably low interest rates. Free money, easy money, driven growth and momentum stocks to unprecedented levels, which Stephen will talk about in a couple of minutes' time. Values really struggled during that period. It's been a tough time for value investors. In fact, it's been a very frustrating time for us. So that's the background. But if you roll forward now to 2018, very significant change in the macro settings, as I think we're all well aware. So quantitative easing is sort of now changing and doing a 180 degrees to quantitative tightening. And also interest rates, as we also now are starting to rise globally as well. So that era of easy money and free money that's driven the growth and momentum trade, if you like, we think is largely over, and we do think that 2018 represents a very significant turning point in that. So that's the first point. That's one of the reasons why I feel so strongly about value from this point going forward. But the second reason relates to valuations. And what I'll do is just ask Steve, do you want to talk a little bit more about that, Steve? Because it really does still differentiate those two categories, doesn't it?
So what we've seen happen in the market over the last couple of years, and really the last 18 months in particular, is a really wide gap open up in the valuations of the expensive parts of the market and the cheap parts of the market. So we've seen the expensive stocks become even more expensive and are now very expensive, while the cheaper stocks in the market have really lagged behind. So there's this massive, unprecedented valuation gap in the market at the moment. And if we just want to use an example of that, a stock like CSL is a good stock for talking about. It's a great stock, good history of earnings growth, good outlook, and as a result of that, it typically trades on a 50% premium to the market. So we're talking with the market trading on 15 times, you'd expect CSL to be trading around 22, 23 times. But today, CSL's trading on 30 times. So when you think about that, all it would take is a reassessment by investors of what they're willing to pay for growth and to bring it back to, say, its long-term PE average, and you'd lose a quarter of your money simply on that derating. And you can say that for there's a whole number of stocks across the market where we can point to that phenomenon going on. So we think there's some real risk around those growthier names in the market. But by contrast, when you look at the stocks that have been left behind, there are plenty of good quality businesses with good balance sheets, attractive dividend yields, and reasonable medium-term growth prospects, which are still trading on attractive valuations.
So to pick up Steve's point there, we really do feel very strongly about this. There are a whole range of opportunities at the moment. And some examples, Ausdrill, stocks in the portfolio at Perennial Value at the moment, Ausdrill, Amcor, Link Holdings, Macquarie, Star Entertainment, Woodside Petroleum, many more, but that's just a nice diverse example of the range of stocks we have in the portfolio. And the underlying characteristics are really important to highlight here, as Steve said. I mean, they're good value, so we're not paying overs in terms of price to earnings ratios for these stocks. Very strong balance sheets, sound medium to long-term growth prospects within these companies. The sort of stocks that you'd want to own in a portfolio for the long term. And within that, of course, which many of you know is a key feature of the way we invest, is that margin for safety, i.e. not paying up and always insisting on investing in stocks with very strong balance sheets. So in summary, we see a whole range of stocks that are offering very good value at the moment, and we think that's a sensible way to invest. So in conclusion, going back to our introductory comments there, the macro settings are changing now. The tailwinds are moving to headwinds for growth and momentum investing. We've been seeing that over the course of 2018. We really do think it's time to shift gears from growth and momentum to value. And one of the other key reasons for that, and I think it's very, very reassuring, is that we're seeing a lot of good value in good businesses in the sort of stocks that we invest in. So I think from a financial planning and from an investment perspective, to the extent that you might have had a great run out of growth and momentum over the last few years, picking up Steve's point there about dispersion, it really is now, I think, a very sensible and prudent time, if you like, to be selling high and buying low, and to rebalance portfolios or shift gear from growth and momentum to the value side of the market, where we are, as I said, seeing many opportunities. Thanks very much for your time, and Steve, thank you. That was
Thank
great.
you.